Howdy there, folks. Welcome into today's reaction video. 3 for me to react to. It's a buy one, get 2 free here today in this one. Inflation is going to drop hard, says Starwood Capital CEO. Hear what he has to say, points he's making in this one. Second video to react to. We are moving from a period of bank crisis to bank recession. Okay, that's an interesting thought there. I'm definitely looking forward to getting into that one and kind of sharing my opinion here. And the last video we're going to react to is markets are approaching a sell in May rotational mindset. So now we're in April now at this point in time, right? And if you've been in the market a while, you've heard the analogy sell in May and go away. And so I think that's an important subject. So yeah, appreciate everybody joining me. As always, 25,200 plus subscribers. Looking forward to getting into this video here today. I appreciate everybody subscribe to the channel. I'm going to get a suntan on this side of my face while I record this one. This is what we call, let's just call it multitasking, getting a suntan while also react to some videos. Hope you guys enjoyed it. As always, let's get into this.
From Marko Klanovic and his team, do you believe right now is the time to be defensive? Is that the way you see that portfolios should be balanced at this time?
Well, I think we are approaching what's called the sell in May period. I've always told that investors don't retreat, rotate. You're better off gravitating toward the more defensive areas such as consumer staples and healthcare in that challenging May through October period. Pacer has a seasonal rotation ETF, SZNE, which I developed that embraces that kind of a strategy. But I do agree also with their last statement that you basically look through the noise, you look beyond the valley, because a year from now, our expectation is that share prices will be meaningfully higher.
Meaningfully higher. So exactly what noise are you talking about? Are we talking the banking crisis? Are we talking rate hikes? What's the noise that you think investors need to look through?
Well, there's a lot of noise out there. I think that the Fed will be raising rates 2 more times at the May meeting and also at the June meeting.
Whoa, hold your flippin' flapjack and horsies for just a moment. This gentleman just said he expects share price to be meaningfully higher at this time next year, but he also expects the Fed to raise 2 more times? 2 more times? I don't think those two things go together. Okay, it's one thing to think the Fed's going to raise two more times. I don't think that's very realistic, but whatever. Let's assume you're going to think that. Okay, I don't think you can also believe this. Stock prices are going to be meaningfully higher at this point next year if you believe the Fed's going to raise several more times. Because most people, I think, at this point in time, believe the Fed's done. The Fed's pausing now at this point in time, and maybe later on in the year, they'll look for a cut at some point in time. So to say they're going to raise 2 more times, I'm telling you, that is not what most people believe now at this point in time. So that would be pretty darn shocking.
I think that the OPEC decision will help maintain a stickiness to the inflation readings. And also, I think the Fed wants to ensure that they truly have strangled inflation, so higher for longer. But then I'm reminded that the Fed does tend to cut interest rates about 9 months after the last rate hike, and that the S&P has seen all sizes, styles, sectors in positive territory in that 9-month period, with the S&P up an average 13%.
All right, so you're bullish on equities, but Sam, I also want to get your take on the latest results from our CNBC survey of chief financial officers. This is an exclusive look at what these financial decision makers think about a number of topics. This is focused on recession. 57% of global CFOs polled say they expect a recession in the second half of this year. 27% expecting it to come in the first half of next year, while 17% say they expect the Fed to actually pull off that soft landing. What's your take on this?
Talk about a bearish stance from CFOs out there. Holy smokes, that's no joke, folks. Yeah, that just means everybody's basically convinced recession. It's here, or it's coming very, very soon. Interesting.
Well, I think a mild recession is built into the cards already. I mean, we have just entered into an earnings recession with earnings in the fourth quarter of last year down about 4%, expected to be off 6.5% in the first quarter of 23, and then 6% in the second quarter. But I also like to say that you can rarely injure yourself by falling out of a basement window. And with the expectations being so low right now, I think that there is room for upside surprise. So I think a lot of this negativity is already built into shares, and I'm impressed with how resilient the market has been in the face of it.
I've never heard that basement window metaphor. That was an interesting one right there. Sam, I know you're also looking at small caps. Looking at the Russell, only up about 2% this year compared to the S&P's 7% rise. Where are you seeing the opportunities in those small caps? Is it certain sectors within the small caps?
Well, what's interesting is that the small cap stocks have taken it on the chin in the past quarter. Worries about the banking crisis, not only for smaller banks, but also for their reluctance to lend to the smaller companies that need that kind of assistance. But when you look at the valuations right now, both the S&P small cap 600 and mid cap 400 are trading at about a 35% relative PE discount to the S&P 500 on forward 12-month earnings.
Who's been calling that out for the longest time now, right? And it has started to come back here over the last number of months. But yeah, still, I mean, if you look at smalls and mids versus large, it's a massive divergence in how those companies are valued.
What I wrote just on Monday talked about those groups that tend to do fairly well in the second quarter. So areas like auto parts and equipment, like consumer finance, environmental services, and energy, oil and gas exploration and production are areas I think could do well.
So when we're looking at small caps, when it comes to the Russell at least, is this a buy the dip? Is this a chance to just buy that index and just hold on right now as it underperforms the rest of the market?
I think so, because certainly we can't know exactly when to time the movement. I do believe that technicals tell you when and how far, whereas fundamentals tell you what. So by looking at the relative performance of small caps versus the larger caps right now, it's basically saying stay away, but some very nice long-term opportunities lay ahead.
Yeah, no, not bad thoughts there. Let me cover sell in May and go away. It's interesting because that's always been the saying, right? But if that's the saying, sell in May and go away, right? We're in a day and age where everybody wants to get ahead of everything. And we know in the market there's a few ways to make money, right? You can be smarter than everybody else. That's not usually going to happen. You can cheat to get there, right? You're likely going down for that if you're going to do that. The other way is be first, right? And so those are three ways you can make money in the market, right? So if you're going to go with the be first one, right? Well, you're not going to wait to May to sell your stocks. You're going to get it done in April, if that's your belief. And if you're somebody that wants to dump out of shares and then buy back at some point in the summertime or fall time, okay? And so naturally, I think what's going to end up happening is it's really going to become sell in April and go away rather than sell in May and go away, because people are going to want to get ahead of that. And by the time you get to May, you might not see any further sell-off unless there's something systemically going on, like something bad in the economy or just in the market in general. Earnings are taking something that is an extraordinary event that takes the whole market down. But I wouldn't be surprised if in the future you actually see strength in the month of May and more selling pressure in the month of April overall. So that's the bottom line, man. We're in that. You ever notice how, you go to a store nowadays and like they're already decorated for the next holiday months ahead of time? It's like you start seeing Halloween decorations at Target when it's still like August, man. It's like, holy smokes, man. I think Halloween's a little bit away. You start seeing Christmas decorations before Halloween's even happened at that point in time, right? You start seeing Easter stuff as soon as they take down the Christmas stuff. I mean, that's just the day and age we're in. Everybody wants to be first. Everybody wants to beat everybody to the punch. And it's no different in the market, okay? Second video to react to here. We are moving from a period of a bank crisis to bank recession. And then we'll get into that last one, inflation there.
Mike Mayo joins us at Post 9. They're seeing deposit outflows too, according to the data, Mike, that Steve just looked at.
Well, look, when it comes to banks, Goliath is winning. The largest banks are benefiting. And in the battle of fear versus greed, fear has pounced greed. But my forecast is that greed makes a comeback when it comes to large bank stocks. And you get earnings starting a week from
says the guy that works for Wells Fargo. Come on, man.
Friday, especially from JP Morgan and Citigroup, two of my favorites. I think you're going to see decent revenue growth.
I thought Bank of America was your favorite.
No, we've reordered things. I mean, I have shifted from, it was Main Street banking was the theme, but the recent events and the bank failures, now Goliath is winning. So, we like Citigroup, we like JP Morgan, we like PNC, we like US Bancorp. Those are four big players. And when you look at the largest banks, including Bank of America, I still recommend it, but the change in regulation for them is not so much. and they have benefited from an inflow of deposits. And by the way, credit quality is still good. So you're going to look at results, I think, a week from Friday and the following week.
Okay, a problem with the big banks, okay, and I don't think enough people are talking about this right now. And this is going to be a lot bigger issue for the big banks if this continues on. These big banks have gotten away with the last, let's call it number of months here, basically giving their customers no returns or limited returns on, let's call it a savings account, CD accounts and things like that, right? And so a lot of people are looking around now and realizing, gosh, if I put money in treasuries, oh boy, okay, I can make a great return. If I move my money to maybe some of the smaller banks, like let's say an Ally or whoever, right, where you can get, let's call it a 3.75% yield, 4% yield or whatever on a savings account, CD accounts at a yield 4% plus. People are going to start moving money out of the JP Morgans, which as a stock I personally own in my dividend account, okay? But they're going to start moving money out of the JP Morgans and the Wells Fargos and the others if these banks aren't going to give them good returns, because people are starting to realize, oh my gosh, I can actually make money on my money again for the first time in the last, 15 years? Literally, this is like the first time in like the last 15 years or so that you can actually make a decent return out there. If from a savings account, but not with the biggest banks. The biggest banks are a joke as far as that goes. And so that's going to be a big problem, because some of these big banks could actually see money flowing out because people are realizing there's other places to put money, whether it be treasuries, savings accounts, CD accounts, in ones that are actually going to want to compete. And at the end of the day, if these big banks don't want to see their clients' money going bye-bye, right, what they're going to do, they're going to have to up what they're actually paying out to be competitive in the market. So I think the big banks are hoping the Fed cuts rates as soon as possible and rates start going down as soon as possible, because as long as that happens, they'll be fine as far as money outflowing. But I'm telling you, the longer rates are high and you can get really good money on savings accounts, CD accounts, and other things from other competing banks, that's when money starts to flow out more and more and more. So the longer rates are high, I actually think it's a worse situation for the big banks overall. And that's not even talked about. Everybody's only talking about like, oh, regional banks in trouble, so people are going to move money from a regional bank over to one of the big dog banks. They don't speak about the other stuff.
The 10% year-over-year earnings growth. And you're going to say, banking crisis, what crisis at the largest banks? And there's some misperceptions out there, and I want to get one thing straight. It's quiz time. Are you ready?
We generally don't enjoy quizzes, but okay.
Okay, so
We interview you. That's how this works. Yeah.
So when I look at a group of banks, 40%, not bank, 40%, a group of companies, 40% would be insolvent if you took out all of their intangible assets. In other words, negative tangible equity. What group of companies am I talking about? This is an easy question, right? I'm a bank analyst. What group?
Thanks.
No, the S&P 500. 40% of the S&P 500 has negative tangible equity.
See, that's why they don't like tests, man. That's why they don't like tests, because then it goes banks.
So if you want to do a burn down or liquidation analysis on banks, I know it's not apples to apples. These are different companies. But just keep in mind that a liquidation analysis is night and day different than analysis based on ongoing concern. There are intangible assets. There's unrealized intangible assets. There are core deposits, relationships with real consumer and payment customers. There's patents.
That's not the debate, though, is it?
No, and the valuation.
The debate is just the earnings profile with sharply lower margins.
Well, now it is.
Yeah.
Well, we're moving from a period of bank crisis to like bank recession. But if I see one more article that cherry picks the unrealized losses at banks without giving credit for the unrealized gains, it's like everyone's a bank analyst. The good news is I could talk about arcane bank accounting with the person on the street. Now, I have something in common with some of my family members now. But otherwise, this idea of a liquidation analysis is crazy. The other thing that really needs to be clarified, J.D. Power has indicated that over 2/3, over 80% of people out there think that the FDIC is just another government agency. In other words, we're all paying our taxes now, and they think their taxes are going to help the banking industry. The FDIC is 100% funded by the banks, led by Jamie Dimon and JP Morgan. So the banking industry is resolving this crisis on its own. So I think this is an opportunity. I think when banks report, greed will take a lead up again, and you're going to see the largest banks at least do quite well.
I'm thinking back to last year when one of the big issues was expense control, and you were on a tear about
By the way, that's a nice dress. Very nice dress.
growth at some of the big banks. Does that change now as well?
Well, I upgraded JP Morgan. with the news of the Silicon Valley Bank failure. That's been the right call so far. They have benefited. Jamie Dimon's CEO letter today says we had record revenues. Well, they didn't report that they also had record expenses. Having said that, these are lesser issues compared to the strength and stability of the largest banks. And one reason is they've had so much regulation, that they are stronger. And the change in regulation ahead for, Citigroup and JP Morgan, Bank of America, and the others will be, not much compared to the rest, the next, after the top 10 banks, the next dozen.
Right.
And the other point that's underappreciated, back to that liquidation analysis that's taken place, the government has really turned things around. In 3.5 weeks, you set up a Fed backstop, you resolved problem banks and sold them. Credit Suisse, a big systemic risk, is resolved. You had debates in the House and the Senate. The White House came out with something, and they're all doing it with an eye to the future without upsetting near-term markets. The White House statement from last week, their fact sheet, said, we think banks should have, more capital after, quote, a considerable transition period. So Jamie Dimon's CEO letter said regulators do not have a knee-jerk reaction. I think he might be concerned about that. He's probably more afraid of what might come. Do not make big changes, Washington, D.C., in the midst of this jittery market. You're one headline away from causing a retracement and concern, so everybody should be hypersensitive to what could disrupt markets.
This is what you argued last week, and that is resolve some of the problem players, right? And no immediate capital raises in your view. Is that right?
That's correct. You don't change your game plan midstream. And that includes the FDIC. The FDIC has a program where banks have to build up the insurance fund by 2018. Now, there's probably going to be special assessments. But you know what? Even if you had another Silicon Valley and another hole, banks could fill that hole where they need to be by 2028, with 1 quarter's worth of earnings. So in other words, the industry has resiliency to resolve, and pay off the depositors and even the uninsured depositors at Silicon Valley and Signature. And I agree, that's not a permanent solution by any stretch of the imagination. But to get through this short period, the industry has enough resiliency to get by. And Jamie Dimon reminded you today, this is not the global financial crisis. As you know, I testified to the congressional committee about that. It's much less players, smaller issues, and when we get from bank crisis to bank recession, we're going to talk about commercial real estate. We're going to talk about lower net interest margins. We'll talk about maybe a contraction in credit because as banks build up capital, they reduce the amount of lending they do. But those are lesser issues compared to the one of, is my money safe in the bank? And right now, you've seen less money flow. So I think things have stabilized. It's day 7, really a stability, but hyper vigilant is how everybody needs to be, especially as you get through this earnings period and we see how some of the smaller banks perform or not perform.
Yeah, the other issue with the banks in general, right, is, and this is important, if we have a scenario in which, let's say the recession does come, let's say it's, I don't even want to say a super bad recession, just a mid-recession, okay, and we see a continued slowdown or just, let's call it residential real estate in a really tough place, commercial real estate in a really tough place, big projects in general, anything construction related that's let's call it non-government related, right? Because you're always going to have government spend, state spend, federal spending on different construction projects, right? Highways and roads and all that stuff. But I'm talking about building a new stadium. I'm talking about building a new hotel over there. I'm talking about building a new apartment complex, right? A new resort over there, a bunch of new homes and everything like that. If we continue to have a slowdown there, it's going to hit all the banks in a major way, right? Because banks, let's be honest, all those big projects are almost always funded by debt. And many times those big banks are the beneficiaries of that. And so that's something important. And also, if you're in a contraction cycle like that, right, there's not as many businesses taking out loans in general that might benefit from those different projects and whatnot, right? So there's so many loans and so much debt and opportunities for banks out there when everything's going right. But when you see a major contraction or slowdown, it does hit the banks pretty significantly, and you see a bank recession over the all, okay? And so there's just something to kind of keep in the back of your mind. That's why I don't own a lot of banks. I own JP Morgan, which is just kind of like a long-term hold for me in my dividend account. I wouldn't mind buying some more JP Morgan in the future, but am I super excited about the banks for the next 12 months? No, I'm not, to be completely honest, okay? Last video up here to react to inflation is going to drop hard. Alrighty, I like that.
Chairman and CEO of Starwood Capital. And Barry, I'm sure you've seen the letter. Jamie makes comments about how the odds of a recession are even higher now. You could be looking at this banking crisis continuing, not knowing when it ends. But he also said that inflation could be much more stubborn than people realize, and that could force the Fed to raise rates even higher than people are anticipating. What would you say to that?
First, I'm a huge fan of Jamie's. So, he runs probably one of the best banks in the world, and he's been an amazing steward of shareholder value. We don't agree on everything. I agree on the recession, as you know from my last appearance, and I think inflation is going to drop hard. And there's a CPI slide that I brought with me that shows why. It is about the rent component of CPI, and food is already dropping, and energy was dropping. Energy is a wild card. You can't actually model what the Saudis just did. Right, if they choose to keep energy prices high, and inflation could be a little more stubborn.
You brought an actual slide.
I did bring a slide.
You brought a slide?
Yeah, I brought
like a staple.
A whole three. There you go. So this is really important. The blue line is actual rents, and the orange line is what the government is reporting. And you can see last month, actually, rents were up 0.8, which is almost a 10% rise in rates. And in fact, rents are falling. If you correct for this, and there's a lag in the way the government reports rental data, and this is 1/3 of CPI, it's 33% of CPI. If you just make the correction of +10, which is what they're reporting, to +4, which is what the nation is seeing, it'll take headline inflation from 4.3 to 2.6. Just that one correction. You will see this in it's probably late summer and the first quarter of.
Boom! Thank you, Barry. Thank you. Oh my gosh. What do I call out all the time, right? This government data is lagging bad. Inflation was way worse way before the Fed said it was, okay? Or before the data showed it, let's call it that, okay? And before the Fed was worried about it. Like, I even in the back half of 2020, early 2021, everybody I knew that was running businesses was all telling me about how much stuff was going up, right? This is going up, this is going up, this is going up, this is going up. It was insane. And yet the government data wasn't really showing it. Then all of a sudden last year, everything is insane, right? And then what I've seen is this has become less and less of a problem. The government data, I think, is way too high now at this point in time, considering where they were at this time last year. And so the government data lags back, okay? And so I'm 100% in agreement with him in regards to inflation numbers are going to drop hard. We're going to see threes, for sure fours very soon here, but I think we're going to see threes this summer in regards to overall CPI. It's just a question of what month do we see it in.
First month of the fall. So all else being equal, inflation's going down. The PPI is down. You're seeing lots of things coming down. Wage growth is slowing. I mean, this isn't a bull market.
Where's the actual rent data come from?
That rent data? From it's a national database, but we have 125,000 apartments. We can model it. It's not even across the country. If you go to Florida, South Florida rents are up 10%. You go to Austin, they're down 4%. Denver's down 4%. There are actually places where they're going down. All over California, rents are falling. Actually, double digits. So in apartments. So the way
Vegas, my main city I live in, I can tell you if you're not competitive with rent prices right now, you're just going to have your house sit on the market. You've got to be super competitive right now. Phoenix as well, same exact situation. You better undercut the competition right now, or your rental, whatever it is going to sit vacant right now. It's gotten so much more competitive over the last 12 months specifically than it was in the past. And so that's just the story. And there's going to be some markets that are outliers that are going to be really well, but there's a lot of markets that are dropping, or they're stagnating in terms of rents now at this point in time in 2023. And that's just going to likely continue for at least the next, I'd say 6 to 12 months.
They do that the survey of households is somewhat archaic. I mean, they started this survey 50 years ago, 1981, before they had the internet. And they've updated it 3 or 4 times, but it's not the way they could go right online to apartments.com and pick up actual rents that people are charging. They call homeowners and ask people what they could rent their house for. Yeah. And if the government calls me, I'm hanging up the phone. I am not telling them what my house could rent for.
We saw those lines. Eventually, they get back to there's a lagged effect.
But can you put that?
You expect 2 or 3 months?
Can you put the chart
up? Actually shows up in the CPI numbers.
No, like 4 to 6 months. And can you put the chart up for a second again? what you'll see is what the Fed missed was when rates were going crazy in 21, their data didn't show it. So while we thought inflation was through the moon and beyond, they said, we'll keep rates low because there's no inflation, it's transitory. It wasn't transitory. That was 100% the result of all the stimulus packages. You know, that was flush consumers coming back to the cities, and rents rose everywhere. New York, Peoria, you know, Dallas, everywhere. It was Albany. I was in shock, and they were up 20%. And so that is what really drove CPI for 5 months in a row.
By the way, I will give you credit for saying at the time you thought
Barry and I, we could agree on a few things. Let's just put it that way. We could agree on a few things.
to raise rates sooner.
Yes. And, you know, they did. I don't know why the Fed has such credibility today when they really are.
They don't have
I saw Leon yesterday.
Do the markets give them any credibility?
No, so I think Jamie's wrong. I think we're going into a serious recession, and the government has an interesting problem, but not for the reasons he stated. They have a massive deficit, and they keep feeding the deficit. That forces rates higher because too much supply of paper to pay for the deficit. Receipts are going down because capital gains are going away. Real estate, as we'll talk as a complex, values are down. So with interest rates up, values are down.
Well, that's the one thing I would say.
So receipts are going down and interest expense is going up. He's going to have to, the deficit will grow. He'll have to print more paper. That should force rates up, which would make the economy weaken further. So he's going to have the opposite problem. He's going to have rates going up and the economy weakening, and he's going to have to lower.
Yeah, my opinion is the Fed's going to cut sooner than I think a lot of folks expect, especially as soon as CPI comes in. Somewhat decent, let's just call it that, which could be as soon as this summer, in my personal opinion. I think over the spring, you're going to see CPI continue to improve and come down and come down and come down. But in terms of that real big drop, I'm expecting likely in the summertime to be those sorts of drops that it's like, whoa. And then the Fed can start to consider, especially once Fed funds rate is significantly above CPI, that's the moment they start to look and they say, okay, what are we doing? Why are we still up here so high, right? And, you know, you could take that a step further and look at government debt, and you could say, okay, every time the Fed raises rates, how much more that costs the government overall. It's an ugly situation. So I think the Fed's going to be closer. I think they're going to pause for a little while here, but I do think the Fed is closer to cutting than I think a lot of folks expect. And the Fed's not going to need to see. A lot of people assume like the only way the Fed's going to cut is if everything's in shambles as far as the economy, banking system, everything like that. No, not in my opinion whatsoever. They're going to be able to just look and say, CPI is much lower than Fed funds rate. We've got to cut at that point in time. Or there's a situation where they're around the same roughly, and let's say the economy is getting into some more trouble. That's a moment the Fed can look at and say, you know, everything's lining up exactly how we think. But I do believe they'll also want to make sure the dragon is slayed. They're going to want to make sure that baby is at least into the 3s before they consider cutting. A lot of people assume it has to be in the 2s. I don't think that has to be the situation. I think they could start cutting before we hit a 2 as far as CPI. I think it could be when we hit 3s, which once again, in my opinion, could be as early as the summer. So I appreciate everybody joining me as always. Thanks so much, folks. Also, if you want to support the channel, you enjoy my content, and you want to support my content, check out my Patreon. That's going to be the pinned comment down there. That as well as the application for my private stock group, private wealth group. And yeah, keep bringing you guys content on this channel. Thanks for being subscribed, and have a great day.